Hello, everyone, and welcome to Pod TV's number one financial show, Wall Street Hackers, with Peter Bennett, who received his bachelor's in economics at UCLA, his law degree at the University of Miami, and his MBA of finance from the New York University. And he spent at least 17 years working in Wall Street. Peter is bringing to us a world of knowledge and information on how you can become a better investor with your money during these turbulent economic times. Everyone, help me welcome Peter Bennett. Welcome, Peter Bennett.
Hey, Kim, really well put. I like the way you explained that last part. Very nice.
Try.
The markets, as always, are very turbulent, is exactly right, especially today and the last week. And the thing is, there's signs all over. To me, it seems obvious, but there's never a guarantee. But there seems signs all over that we're headed for recession. First of all, the inverted yield curve has predicted 6 out of the last 6 recessions. And that's a pretty good percentage, 100%, right? But it's also historically inverted. It's not like a little inversion, it's a lot of inversion. Now, some people say, oh, well, why hasn't it hit yet? Well, the inversions and recessions usually happen 6 to 24 months after the inversion. Well, it's been about a year. So there's plenty of time within the normal frame for a recession to hit, and I believe it will. Then you look at the Fed's fight of inflation, if you can even call it that. I've been saying for a year and a half now, the Fed is so far behind the curve. And so the PCE, Personal Consumption Expenditure Index, came out just this week. It gained 3.8% in May, year over year, 0.3% for the year. The core PCE, that's very important, is 4.6% year over year after 4.7 in April. Not much change. And these are the numbers that the Fed uses that they wanted to use as their 2% target. So that's a long way, and that's the hardest part. Bloomberg explained that to get from maybe 7 to 4 was one thing, but to get from 4.5 to 2 is a long way to go. And the thing is, the market is delusional. It doesn't have any idea. And then I heard today, I believe, or yesterday, I think it was today, ADP comes out with an employment report. It's the strongest hiring month. June is the strongest hiring month in 12 months. So where exactly is the Fed fighting inflation, and have they had success? Yeah, the numbers came down a little bit. But the problem with these numbers is they keep including oil in a lot of them, oil and gas and energy prices. But the thing is, energy was never going to stay down. In my opinion, it's going to go up, if not this summer, which it could go much higher, next year, a year after. We are in a black swan, possibly, of energy. And I'll get into that in 1 second. But the point is, these numbers that the Fed is using and the markets are using, saying, oh, look, we fought inflation. Well, but take energy out, because energy was down for the last year. Why was energy down? China closed down because of COVID for a while, and it was a very warm winter in a lot of the world. But not every winter is going to be warm, and China's going to be open, very likely. So you take that and you say, energy, what happens if it stops helping or even starts hurting? And you'll hear in one of the quotes of the week, I see energy going through the roof in the next few years. And it's really a black swan. And in other words, it's unpredictable, but unpredicted by the market. So it's going to be a surprise. But the market doesn't even hardly talk about the long range in oil. They always talk, oh, it'll be going up in 6 months or 3 months. But I always focus on the fact that if you look at oil production and the capital that's going into the oil and gas sector, it's less than half of what it was in 2015. Now, these projects take 5 to 7 years. So we're talking about a potential, not just black swan financially, but even for society. It could easily blow up in everybody's faces, because the thinking is, solar is going to replace it, and EVs, which use oil and gas anyway, but do reduce demand. And everybody's saying, oh, this is going to replace it, so we can almost get rid of it. We'd like to get rid of it because of climate change. And I understand the climate change arguments on both sides. And I am concerned because I think probably there is a climate change issue, but that's not the point. The point is you can't get rid of oil and gas until you really have good substitutes. So the whole industrial revolution was based on oil and gas, and we are dependent on it. And I think there could be a shock, if not this summer, next year, but I wouldn't count on it going down. So quotes of the week. This one really summed up why this could ignite inflation again, which will totally shock the market. So the quote of the week, number one, this comes from a report by a stock analyst who I've seen for years, Elliot Gu. He's pretty knowledgeable. And here's some of his summaries in his report. One, the International Energy Agency forecasts 2023 global oil demand to jump 2.4 million barrels a day to a record high of 102.3. I remember just a few years ago, it was 90. And I've been saying a lot of forecasts say oil and gas use will go up till 2050 or 2040, at least because of increased use by developing countries. So we're talking about more demand, but that's not how the market for oil sees it. It's like, oh, it's going away. We're at peak oil demand any day now. So this report also said if OPEC and IEA estimates are correct, oil prices should trade into the $90 to $100 barrel range for Brent in the second half of the year. The only way to square the current weakness in oil prices with the tightening supply-demand balance is to anticipate a global recession in the second half of 2023. Well, I think we're going to have high energy and, unfortunately, a recession, because if you look at recessions, a lot of them are caused by high energy prices. At least three of the last six major recessions. So other quotes of the week. And, of course, I pick quotes that I agree with, but these are pretty credible people. We're talking about UBS and Morgan Stanley now. So Morgan Stanley's quote, "We see persistent core inflation to mean U.S. rates could move higher and stay at these levels longer. With global and U.S. stocks more than 20% above October 22 lows and a more challenging second half outlet, we believe investors should position for more lackluster stock market performance through the remainder of the year." And I would point out, yes, the market's up a lot this year, but since, a year and a half ago, it's still not come back to where it was. And inflation, if it's 6%, is eating away at that money. But number two, Morgan Stanley. Even though the S&P 500 is up just 20% from the October 22 low, that does not mean the bear market is over yet. The bear markets of 2000 and 2008 both saw rallies in excess of 20%, which did not constitute the end of the bear market, as the market experienced further downside after those rallies. So it could be a bear market rally, and that's what I think it is. Maybe, there's never a guarantee again, but that's where I think we are. And the other thing is, I think oil's going through the roof at some point, very likely. I don't think it's going down for sure because of this huge underinvestment of capital that's going on for 7-8 years because of ESG and because of a lot of other factors we talk about on the show. So 5 most interesting stories of the week. I thought this was interesting. The right to repair laws are sweeping the U.S. So legislation enacted or introduced in more than 24 states requires manufacturers of everything from smartphones to farm equipment to make it easier for consumers to take damaged products to an independent repair shop or fix it themselves. So we all know something breaks, your phone breaks, and maybe you have to replace it, depending. But so far, 3 states passed these laws: New York, Colorado, Minnesota. And in different states, they apply. So if I even mention your state, you have to look it up and follow what's being passed. But they talk about, in some states, smartphones, laptops, farm equipment, household appliances. Other states that are now pending and will probably go through: California, Connecticut, Georgia, Iowa, Maine, Massachusetts, New Jersey, Oregon, Texas, and Washington. So that's just a start. I think that, these laws will continue to be passed. And I think they're a big positive. Number 2, Elon Musk may have agreed with limiting voting rights to parents. A Twitter user said, quote, "Democracy is probably unworkable long-term without limiting suffrage to parents." Musk replied, quote, "Yup." So, the thing is, there's a bunch of points about Musk. First of all, the line between genius and insanity is very close. And in his case, it's extremely close. He's brilliant in so many ways. But I knew over a year ago when he was saying, "Oh, Bitcoin's so wonderful," and he was allowing people to buy Teslas with Bitcoin, and then he realized that energy Bitcoin does a lot of damage to the environment by using huge amounts of energy. Other countries had recognized that by the time he was advocating for Bitcoin and Bitcoin use for Teslas, and eventually figured it out. But this show had mentioned it for 6 months or longer. I'm going, how did he not know that? So he's brilliant again and on the border. Number 3 story, New York and California saw the steepest drops in tax-generated revenue this fiscal year, while New York collected 19.5% less in revenue, and California saw tax revenue fall 24.9%. On the side, Texas increased revenue by 12%, and Florida 9.9%. The populations of each state in those 2 states fell by about 300,000 since last July. So these are very negative trends, and the people who are moving out are probably higher income people they are. And so in the long run, the policies of these states might want to be looked at, especially certain policies, like even no matter what you say, I mean, pro-crime policies is what I call them. That's crazy. They're just, they have to find a balance in their policies. And New York will survive. I expect even the city probably will do okay. California's going to have even bigger problems. Number 4, the Biden administration Bureau of Land Management just unveiled federal regulations that would allow environmental organizations that are opposed to fossil fuel drilling and mining projects to lease land for conservation uses, thereby blocking resource development. Montana Attorney General said, what you've got now is the BLM, Bureau of Land Management, trying to shove through another overarching sweeping rule that's not supported by the Federal Land Policy and Management Act. They're trying to argue that conservation now somehow fits within the definition of federal land policy and trying to do it by rule. So the United States, the government owns 28% of the land already. And they're trying, if they start leasing out a lot of this land and making it inaccessible for oil and gas, that'll just be another of the roughly 100 policies they have, which will limit oil and gas production. Again, I understand the climate change, but you need smart policies. And we've criticized these policies a lot, even from an environmental perspective. I always point out that in 2021, both in the United States and the world, and in 2022, both in the United States and the world, carbon increased in both. So and there's reasons these policies are causing some of that increase, at least. They're really weak policies. Finally, a Census Bureau report said that 33% of Americans are now working full-time from home. That's up from 25% in 2019. And the other interesting thing is the average person who works at home put in 2.5 hours less per day than their colleagues in the office. Office occupancy, by the way, remains at sub 50% in the largest U.S. cities, which, as an aside, is why I've said for over a year and a half, avoid a lot of REITs, like office REITs, even storage REITs. There's just too much vacant land out there in terms of offices. But some would argue that bringing this will mean that workers should come back to the office. But the other side is, I wouldn't be surprised, because I worked in corporations for over 17 years. And there's a lot of wasted time in the office, so maybe a lot of that 2.5 hours, it really isn't productivity loss. I think the trend for remote work is generally here to stay. I think it's pretty clear, and that's going to continue to cause an office market crash. Anyway, we'll take a quick break, and then we'll have our investment of the week and also our discussion of the week. See you soon.
Oh, beautiful travel for spacious skies, for amber waves of grain, for purple mountain majesty above the fruited plain.
Oh, nice ad. Okay. So what to do, and really hasn't changed for a year and a half. I mean, you have a good strategy, stay with it. Any of your stock allocations should be in dividend stocks. I mean, we have our chart, which I don't think we showed this week. I forgot to show that. Oh, there you go. And it shows that, thanks, Kim. It shows that if you had put $100 in 50 years ago into an equal weighted S&P 500, you only have $4,000, which is still a huge return 40 times. But if you put it into dividend payers, you have twice as much at 8,000. Or if you put it into dividend growers and initiators, you'd have 13,000. So where am I putting my dividend stock allocation? Definitely in dividend payers. It is never a guarantee, but that's where I think it is. The other thing is energy. You know, I think we're getting closer and closer to a black swan in energy. I haven't used that term as much before, but I just don't think that you can keep underinvesting by 40% in long-term projects and not have a shock to the system. So it might be next year, might be the year after, but this could be a really big shock to the whole world. We are so dependent on energy, and if energy prices go up, it's a tax on people, and it's also an inflation factor that will be impossible to overcome, basically. So the Fed will be fighting harder and harder. It's really negative. And as a matter of fact, I just increased my allocation to 28% in energy, mostly pipelines, which I love, but some other producers too. And I hedged the 28% with 3% in options just in case I'm wrong, because you never have a guarantee in life. So if we could take the chart down, we'll get into the investment of the week. So this week we have an energy related thing. I did a last 3 weeks on grocery oriented stocks where I think there's still value. People need to eat. And but this is Kimberly Royalty Partners Limited Partnership. And I put a 1% allocation of my portfolio in there, and it's in my IRA, and I'll explain that in a minute. But basically, it's a royalty trust that owns huge amounts of oil and gas land. It's like BSM, which I'll probably get into next week. But what I like about it is a lot. It's got a 10% roughly dividend yield. According to TD Ameritrade, the price over cash flow is 6.1 times. So that means that it's getting 14% cash flow to cover that dividend. And it has great 5-year history. According to TD Ameritrade, it's increased its dividend by 17% annually for the last 5 years. And its revenue growth has been, I believe it's at 51% annualized. So now oil was really low 5 years ago. So that's some of the results. But the thing is, I think it's probably going higher. Now, whatever you think, I think you have to own some pipelines and you have to own at least some producers, because if you have any other stocks, if everything goes as high as I think it might go in oil and gas, then everything else will probably get crushed. So you need it as a hedge, in my opinion. So another thing I like about it is its debt to EBITDA, EBITDA, is very low now. It's 1 times, and it was 2.2 in 21. So they've reduced their debt even lower. I think debt to assets is 18%, which is very low, again, for any company. And another reason I really like it is I just discovered this last week, which was why I went from a very small piece to 1%. Even though it's a limited partnership, it pays its dividends as a regular dividend, and not as a K1 partnership dividend. So you don't have to worry about UBTI in an IRA. You can look that up if you don't know what it is. And also, if you own it outside an IRA, last year's last quarter's report said 72% of its return was return of capital. But I especially like it in an IRA, as I said, because if you get 10% a year for 10 years, you get all your money back. So, and again, it's a lot of these other partnerships can be painful in the IRA because of the UBTI if you have too much. I think it's critically important, again, to own oil and gas as part of your portfolio. So now let's get into the panel discussion of the week. And it might be controversial a little, but not too bad for a lot of people. So the question is, should the U.S. Hi, Kim. Should the U.S. disengage from China? And should disengagement, if you're going to have it at all, be slow, fast, or not at all? And quick background, one, there's obviously a lot of potential issues politically between the U.S. and China. I don't have to go into them. If you watch the news, you know about the South China Sea. I think everybody knows about that. Number two, the U.S. Commerce Department recently limited high-level chip exports to China, which, by the way, could really hurt the chip industry if there's especially if it grows into a bigger war in the chip industry, because then trade back and forth on chips may be hurt. Another point is a benefit is, it's obvious, the U.S. and U.S. consumers get huge benefits from China. I mean, I buy on Amazon a fair amount of products, and a lot of it's made in China, and it's really cheap. You go to Walmart, it's so cheap. So if we don't buy from China, first of all, that will fuel more inflation, which is such a problem now, and it hurt the lifestyle of people. So it's a real plus for China because of the inexpensive goods. What's interesting is China has adopted a modified capitalism, and this was a long time ago in the 1980s and 1990s. So many of the state-owned enterprises operate like private sector operations, and they retain all their profits. They're not even taxed, which doesn't seem fair exactly either. But they adopted the capitalist model maybe a decade or two ago, but I know it was on the advice of Goldman Sachs. Goldman Sachs came in and consulted for them and said, why don't you change to this model? So it's working. Thank you, Goldman, for giving them advice, whatever. But anyway, another point is many argue, and there's definitely some benefit to this. And if you have big economic ties between countries, they're not going to get into a world war. There might be a Cold War, but there's not going to be a war, very likely, because it'll crush both countries economically. So the final thing is, this isn't proven, but I think there's something to it. There are many claims, but they are, again, unproven to date. But I see a lot of evidence coming out. There's a lot of smoke. Anyway, we'll see what happens. That the Biden family has received very large amounts of money from Chinese entities, including the CEFC, which is their energy company. So that might be a little undue influence on our government, too, not to mention other issues with, China influencing or spying on U.S. companies. So, question for Kim first, because it's our panel, among me. Should the U.S. disengage from China? Should we disengage slowly, fast, or not at all? What do you think, Kim?
Well, if we do disengage, I think it would cause a huge rift in our economic situation that we already have. Mm-hmm. I think we just need to learn how to work with them a little bit better. They do own pretty much every microchip in every device we have. That's why I think the whole hoopla about TikTok is stupid, because if you're going to block TikTok, you might as well block this. And I also learned why they wanted to do that. But aside from that, China, they own most of our land in our country. They own our banks. I mean, what are we going to cut off? I mean, come on, let's think about this before we cut our arms and legs.
They own a lot of, they're trying to buy even more farmland, but they don't own most of it. I mean, we have to correct that.
They own a lot.
They own a lot of land. They what they do own a lot of, by the way, I didn't even think this, is treasuries. They own a ton of treasuries because they invest in the United States through treasuries particularly. And you're right, there's so much economic dependence. You're right.
Yes.
So, all right.
Absolutely no sense.
So here's my conclusions. One, the U.S. is much too dependent on China.
Exactly.
For our medical supplies, first of all. I mean, this is obvious. And minerals. I mean, I believe I read it was 85% of our drugs are made with Chinese components or something like that. It's like, what if they cut us off? It's like, why would you want to be dependent on one country for this? a lot of the minerals, especially that are going to EV batteries, but a lot of rare minerals are coming from China. And the U.S., by the way, is so short-term sighted, because whenever there's maybe a mineral, there was a mineral project, and there's probably been others that were squelched. Basically, we can't have a mineral project in our state or near us. It's an environmental problem, but it's okay to have it in another country, which is what we do. We export the pollution, so we have a lot of dependence. Number one, and this is obvious. Number two, the Chinese are very serious economic and hopefully not political competition. And many forecasts say they'll have by far the largest economy by 2040, 2050. And India is also growing a lot too. And that's the forecast is clear that they are growing quickly. And I'll put a little footnote that they're really smart in a way, because the United States we have certain advantages. Look, we have a really free market. We don't have government intervention too much in a lot of areas. So, and people work really hard in the United States because of the capitalist system. It made us the richest country in the world, without a doubt. But on the other side, long-term thinking, we're a little short on in the United States. Why? Number one, we have elections. So, if you're running for office in 4 years or 6 years, it's very hard to tell people we have a long-term problem. You want to just tell them what you can to get elected, and also maybe satisfy the lobbyists so you get money. So we're very dependent on a short-term cycle. Whereas the Chinese, they say, think of 100-year cycles. And they can do that because their government can do something that's unpopular and nobody can really do much about it. So they can think, well, look, 20 years down the road, 10 years, 20, 30, 40. So they're very smart that way. And they've been very smart. That's why they've been so successful since the 80s and 90s, when they did take on modified capitalism, when they adjusted some of our benefits and not all of them. I personally think that the U.S. should diversify from China as quick as possible. And that's the tricky part. And that's the answer. And maybe that's obvious too, but we need to do it and we need to push it, but we can't push it too hard because we're so dependent on it. But I think of the expression, turn the other cheek. And so from the Bible, I believe it's biblical reference anyway, people say it. And the thing is, their rhetoric is horrible towards the United States, and we are dependent on them. And there's so many political issues. So why wouldn't you, and it's happening, by the way, but I don't think fast enough. We need to have policies to encourage it. But a lot of business is moving to India, which if I was picking another country to invest in right now, I'd look at India. And India is great. And Southeast Asia, surprisingly, Vietnam, our old enemy, is getting a lot of business. Southeast Asia, Malaysia, these are countries that move. Businesses at least are smart enough to say, we better diversify just in case. But still, to have that kind of dependence, it's too much. And so I think the United States better smarten up, and we better keep pushing that issue of trying to find ways to diversify as quickly as we can. And, and then see where it goes. You know what? My attitude in the end would be, let them operate their way. Let us operate our way, keep peace and see who succeeds in the long run. I think without the benefit of all our inflows of capital, and if they really operated themselves in the long run, we'd be the economic winner. But nobody knows. It's a long ways off in 20 and 30 years. And who knows? They're smart. They're operating very smart. I mean,
they're patient, Peter.
Well, yeah, because they have the
They're patient. They invest in future. They don't sit here and go, oh, I'm going to do. I mean, we've sold off our pig farms to them. We've sold off, a lot of our food processes to them. They own the chips. They own there's just so much.
The EV batteries, especially there are a lot of them are being manufactured in China now. So it's like, okay, we're going to push EVs, but that helps them again economically and hurts us. So Ford pulled out of China. They pulled their manufacturing out of China and they moved it to the U.S. But their cars are not going to be affordable now. So but Ford is like, well, you know what? We're going to start investing and reinvesting back in our country here. And so they did. They pulled out and put they're building factories here, which gave our local people jobs to build, construction jobs. Soon it will become manufacturing jobs. So. But the thing is I'm learning, like I go shopping and I'm listening to our economic situation. People aren't going to work. Yeah,
I was out touring the wine country.
I mean, they're working.
And
Oh, yeah.
people called in and didn't show up to work all
I
weekend.
know. Well, you know what? But the inflation's going to put pressure on people to go back to work if it keeps coming, because that's the problem. Again, it will get people back to work, but it's not good.
And there have been huge layoffs. I've got family members that got hit in layoffs. They were willing to go to work.
Unemployment situation right now it's historic lows right now, but I mean, it's going to change. It has to change, because you can't have a country where nobody's working or not enough people working. I think
people got used to getting paid for not working during COVID. I think that was a bad call.
It's a shift, but it's not going to stay that way. I don't think it will. And again, inflation's going to drive changes, and unfortunately, energy inflation may be the biggest change. That's really going to shock people.
Well, maybe next week we can also talk about the influx of the interest rates. So like in savings, now I can earn about 5.25%, but in interest rates for my debt, I'm paying close to 10%.
Oh yeah, easily. Margin rates at a lot of the brokers are now 13%. So exactly. You're paying on the front end, and the difficulty for investing, by the way, and then let me make one for the final point, then we have to close up. But the difficulty is, you can get 5% today, but if once we hit a recession, that's why I like to lock long-term bonds in, because exactly. Once when we hit a recession, let's say we get another year of inflation or another year, at some point, it's going to really tax the economy into recession. The Fed increases are going to tax the economy into recession. But then the problem is that's when rates go low. So you got 5%. Now inflation maybe stays much higher, and now the rates go back down. So it's tough. And I would like to point out that, and besides that, I forgot to mention South America. I mean, here's our natural ally, these countries. And, there's some communism and socialism moving to these countries. This is where we should be building relationships with to diversify, even from India, because these are countries that are close to us, in terms of transportation. They should be natural democracies, but a lot of them have even recently turned communist or socialist. Yeah. And these are countries we should be supporting. It's the old Monroe Doctrine from the 1800s. It's like, why didn't we finish up on that idea? So anyway, we'll see. Every week brings in another adventure. Watch the market. I don't know what will happen, but it could be a very worrisome summer. It's a very big down day today. And I think energy prices are going to be going up. Again, who knows? And by the way, there's never a guarantee. These are just opinions. This is just for entertainment. And that's our disclaimer. You should consult your financial advisor. These are just our opinions. I forgot to say that when I talked about KRP.
I've been putting it up. So, but yes, thank you for saying that, because we are on iHeart and
exactly. Now we have new Spotify and iHeart. So thanks for watching. We'll see you next week and almost every week during the year. As Kim always says, get healthy, get wealthy. One of my favorite expressions. And we'll see you next week. Bye-bye.
Take care, everyone. Thank you for watching.
It says you're in the show, everyone can see and hear you.